Hi everyone, and welcome to another episode of Get Social with Bond Finance. My name is Sarah Wilkins, and I'm here with my co-host, Bruce Mainwaring from Bond Finance. Hi, Bruce.
Hi, Sarah. How are you?
I'm good. How are you?
I'm tip-top.
Good, good. Bruce, today we're going to be chatting about commercial valuations.
We are, because there's lots of mystery about commercial valuations, and lots of clients give me a call and they don't really understand the actual valuation they've received. So I thought it'd be good to do a little podcast just to go through the difference between VP and 180-day block discount and commercial yield-based valuations.
Fantastic, fantastic. First, you're going to tell us a bit more about Bond.
Yes, certainly am. Thank you, Sarah. So I started Bond Finance back in 2004 with my business partner, Dan Newbury. We're FCA regulated and founding members of the NACFB. If your brokerage doesn't have those two accreditations, please find another brokerage. Our brokers are CMAP qualified, we've basically got two departments. We've got a residential and buy-to-let department, and we've got a commercial department, which basically deals with everything else, be it ground-up development, buying an office block. We pretty much cover all aspects.
Bruce, can I stop you there? What is the difference between FCA and the NACFB?
Yeah, so the FCA basically regulates all regulated contracts like your main house, your PPR, and the NACFB oversees all the non-regulated lenders. And it basically keeps the standards higher than if there was no oversight, basically.
Okay, thank you.
My pleasure. This is the merry band of ladies and men in the office. We're a medium-sized firm based next door to Bank of England on 50 Gresham Street. And today I am covering off what is meant by these different terms, like vacant possession value. What is market value? What is 180-day value? What is commercial yield-based valuation? And what's a block discount? And hopefully I'll be able to give you a better insight into that. So any property, be it residential or commercial, has a bricks and mortar value. Okay, it's got inherent value. And for commercial properties, it's called the VP value, the vacant possession, the value of that building without any tenants in it. Okay?
Yeah.
Lots of lenders lend off the VP value. You've then also got the market value. The market value is what the valuer thinks the property could be sold in 12 months with the benefit of a tenant in place. So if you've got a tenant there on a 5-year contract, it warrants a little bit of a higher value because you're getting some income in for the next 5 years.
Okay.
But lots of lenders only lend off the vacant possession value because the covenant of that lease is probably quite weak. The tenant in there is not a Barclays Bank or Costa Coffee. Okay?
Yeah.
Now, the 180-day value is what lots of bridging lenders lend off. And that is basically the value of the building, which the valuer thinks it could be sold in 6 months. And generally, you have a difference of between 5 and 10% between the VP value and the 180-day value, because the property needs to be sold quicker.
Okay.
Then I'm going to touch on is the strength of the tenant. Now, the strength of the tenant is called the covenant, or sometimes provenance. Now, a small retail shop with a one-man band on a 2-year tenancy hasn't really got that much strength to him. But a Tesco's Metro on a 25-year lease offers considerable value, considerable income stream from a safe source. And if you do have a strong tenant, you may be able to get an investment-led valuation known as a yield-based valuation. So if you've got a Tesco's in there on no break clause, is actually worth some money, that tenancy, and people are willing to pay a premium for that income coming in on a regular basis. Now, I've seen yields as low as 1% for a bank tenancy in the city. Somebody just wanted just to buy the building because it had a tenancy in it, and the income he was deriving from it was just 1%. It was just basically to park their money where it's safe and sound. They didn't want to park it in cash somewhere. So, to sum up, we've got vacant possession value, which is the bricks and mortar value. We've got the open market value, which is the value of the property with a tenant in place when it was sold in 12 months. 180-day is the value of the property when it's sold within 6 months. And a yield-based valuation is when you capitalize the rent to produce the end value of the building. But to get a yield-based valuation, you need a very strong tenant in place. You can't have secondary security and secondary tenants. So this is an example of a typical commercial valuation. And we've actually got 4 different valuations here. And how confusing is that for the client?
Yeah.
They're going to go, which one is the bank going to lend off? Well, the first one is the open market value with the tenant in place. The second one is the open market value with vacant possession. So you can see there's a difference of £90,000 between the two. Most lenders like Shawbrook, Interbay, all the challenger banks will lend off number 2 valuation. They won't give any value to that tenant in place because in this particular time it's a very weak tenant. The third valuation is actually vacant possession on a 180-day value at £1,125,000. So that's a £125,000 difference between number 2 and number 3. And that one, number 3, is what the bridging lenders will lend off.
Okay.
How confusing. How confusing. Now, and the last one is basically assuming the tenant's in place on a 180-day value. So you can see there's different valuations popping up here, and different banks will use different valuations. And you need to understand the valuation methodology to work out how much money you're actually going to get out of the property.
Okay.
Right, block discounts. Block discounts. Now, if an investor was to buy a block of flats, he would want to get a good price for it. He wants a bit of a discount because he's doing a bulk buy.
Yeah.
It's a bit like going to Costco. If you're going to Costco and buying 64 bog rolls, you want a bit of a discount, don't you?
For sure.
Yeah? It's the same principle. If you're buying a block of flats, an investor would want some sort of discount. Now, the strength of the local market really determines what sort of block discount you're going to get. Should we say it's a block of 5 flats, and it's in a really strong area where flats are being bought and sold, you're probably going to expect a smaller block discount than in a market where there's no properties being sold on a regular, on transactionally. So, and generally block discounts generally start between 4 and 6 flats because they only really appeal to an investor. And if it's in a strong market, you're going to get block discount starting about 6 flats. If it's in a weak market, you're going to get block discount. The valuer is going to start giving block discounts with 4 flats. Now, the reason why I'm bringing this up is for all the people who are doing the build to rent market, because you need to understand if you're building a block of flats and it's not 200 where you're going to get a yield-based valuation because you can sell it on to a pension scheme. If you're building, should we say, 10 flats, you're going to get some sort of block discount, and that could be anywhere between 5 and 15%. So if you're an investor, you just need to be aware of this when you're doing your NGDV valuations, you're not going to get the aggregate valuation if you're looking for term funding. You're going to get a little bit off that, depending on what the market is. Well, that's my little synopsis about valuations, Sarah. I hope it was worth watching, and I look forward to seeing you two for our next episode.
Thank you so much, Bruce. Super, super insightful as per usual. And I will see you next time. Thank you for joining us, everyone, with Get Social with Bond Finance. Remember to click and subscribe and follow us. Bye, Bruce.
Bye.